You're listening to the Right Club Podcast, where the focus is all about helping you grow your real estate investment portfolio and live the life you want to live. Come grow with us and join our community at therightclub.com. And now your hosts, Sarah Larbi and Alfonso Salemi.
So that's interesting. So let's take maybe the last deal that you guys have done, and I'm guessing you work together in some capacity. Can you walk us through what that looked like, what it was, and how that came to fruition, I guess, if you call it?
Sure. So our first two offerings. So these first two offerings that we brought to the table were in 2019, and so we did one that was a 66 unit apartment building, and we acquired that one. So we acquired that one actually with an operating partner. So somebody who's a property manager and has that as a part of their business. They are expert in arranging financing for these types of projects. But we bought this particular asset because it's a value add, and that's in real estate or private equity real estate terms, that's kind of like your BRRRR. That's your BRRRR model, but just at a greater scale. So that was the first project that we brought, and then the second one was a group of townhomes, so a townhouse complex. But we bought that because it was a stabilized asset. It was stabilized income, and we liked the long-term prospective value of that plot of land and just the asset itself. So it didn't need to be stabilized. It didn't need to be remarketed. It was just there because it was a nice, strong, stable investment. So just like you may buy individual properties for different reasons, meaning it doesn't need any work and it has the good possibility for cash flow, you would invest in that differently than if you were investing in a fix and flip or something where you want to drastically improve the asset by investing in it, right? Your kind of your BRRRR model.
Okay, so you find the assets and now you say, okay, Ryan, I need to create an LPGP type of partnership because I need to raise money. Is that what happens next?
Yeah, to a degree. So the GP is just a corporate structure that takes on all the risk. So it can sign for title, it can take on debt, but it creates the limited partnership. And it is because the limited partnership itself is just a flow-through vehicle. It's a flow-through structure. So it flows through profits and cash flows and liabilities and whatnot. But so all of the risk is taken on in the general partnership. The limited partnership as a structure itself is created. And so, for example, what I would do is say, hey, Ryan, we're creating a limited partnership for this particular purpose. And then I would give him kind of the requirements that I'd be looking for in having it, give it over to him, and then he would make sure that the partnership agreements were written accordingly for what we were wanting to do with the investment.
So what would that look like, Ryan, in accordingly to, I guess, what Adam would require?
Well, so like terms within the agreement or
yeah, like are there some things that like as an investor you're like, I really want to have that into the GP LP agreement. I need to make sure that I emphasize these points.
Yeah, and I'm only assuming these documents are, a little bit, couple inches
pages
thick
and pages and pages.
Right. So to pull out some tough conditions and clauses, I think more of the question is if I am the partnership, like how am I staying in touch? How do I know the success, the failure, the ongoings of said project to make sure that and what are my obligations to do as well? Obviously the investment, but then knowing what's going on and the communication between the two.
Yeah, I think it's kind of like what Adam was saying before it's the BRRRR method, but like on steroids basically, right? So you're taking the legal documents that you'd normally have with, I don't want to say a simple BRRRR, but a lot of times a BRRRR could just be a single family home that you're, tearing out, renovating, refurbishing, refi, repeat, that kind of process, right? So, maybe to back up, a lot of the terms and so forth that go into the GP-LP agreements to formulate the arrangement between the investors and the general partner, which is basically Adam's company, or typically Adam's company. It come out of basically like an offering memorandum, investor deck, right? If I'm not mistaken, Adam. Like Adam's got basically just like you would see if you were buying any sort of investment, a very detailed offering memorandum, which basically would give you, you know, the full layout of this is what this investment is, this is what the expected, you know, rates of return are right now. This is what it's gonna. These are our opportunities with it. We could go plan A, plan B, plan C. These are the rates of returns on all of them. You know, it talks about how much money are you looking at to invest. So a lot of the practical stuff is laid out in more, I'll call it layman's terms, in that offering memorandum. And then the legal agreement of the partnership agreements, the GPLP structure, basically just takes what's in that memorandum and starts flushing it into the legal framework, right?
So some of the simple things we would do is we would provide a certain type of reporting monthly and a certain type of reporting quarterly and then a certain type of reporting annually. And each one of those stages is a little bit more intricate and a little bit more detailed. But as the sponsors of an offering, of a limited partnership, we take it pretty seriously in terms of keeping people informed. And just our own practice, it's not that this is defined in law in any way, but our own practice is that we're as proactive as we can be. And as I said, it's the simple things like we know that this particular type of report is going to go to investors every month, and this particular type of report is going to go out every quarter, and then so on. Some of the things that investors would like to know is, you know, how do I actually make an investment? Like, what does the mechanics of that look like? Or how do I get out of my investment if I want to get out?
Yeah, absolutely. So what's the answer to, because those are great questions. Absolutely.
Yeah, no, and I think if you're investing in something like that, those are really good questions to ask. Now, there is no rule around what you have to offer. It's more about the general partner and what they're willing to do or how they want to conduct business. Let's say, for example, for us, if you have a very traditional investment, a very traditional investment fund, like a mutual fund, one of the key characteristics of that is the fact that it's liquid, and sometimes it's liquid daily, meaning you could buy into that or get out of that daily, or if it's maybe it's weekly liquidity. Now, some of the reasons why you might want to invest in a private structure like a limited partnership is because it doesn't offer some of that liquidity. And now you could say, well, maybe that's not a good thing, but what it does is it allows the general partners and the sponsors to actually execute on their business plan. But that said, what we offer is annual liquidity periods. So that's the way our structure would work. And that's because we're a smaller boutique, so we don't have the liquidity built in. So we would have to, if somebody seeks liquidity or wants liquidity, meaning they want to get out of their investment, we would be looking for a replacement investor. So now, practically speaking, life also does happen to people. So, you know, unfortunately, divorces happen, and, you know, deaths in the family, and these different financial events where people may need liquidity, in which case, if you have a good general partner, that should be relatively simple to find a way out. But for us, what we say is annual liquidity periods on a best efforts basis. And what we want to do is we want to value the asset or value the partnership before we provide liquidity, because there's going to be growth and there's going to be change over the value of that asset over the year. And so we would offer that liquidity period after we've done our annual valuation of the asset and done all of our accounting and all of that good stuff has been done. So we set the new price, offer liquidity over a certain time period. But one of the things that I would say is beneficial to a structure like this is these are often more liquid. They should be more liquid than if you just have purchased an asset outright, meaning you've gone and, you know, acquired a home or acquired a condo unit or a townhome. That period of time from the time of listing to the time of closing, you're probably around 90 days for something like that. Is that probably accurate?
Yeah, that's up. Yeah, for single family residential.
Yeah. Whereas reasonably speaking, in a structure like this, you should be able to have your liquidity within 30.
Thanks for listening to the Right Club podcast and joining our community of real estate investors online at therightclub.com, where the focus is about helping you grow. We look forward to seeing you again next week. Thanks from your hosts, Sarah Larby and Alfonso Salemi.